So, at the end of 2025, if you looked at China's official economic report card, everything seemed pretty rosy. But beneath the surface of those big, strong annual numbers, a really worrying trend was starting to take hold. Today, we're going to ask, is the Chinese consumer actually in crisis? Let's dive in and break it down.
This is the kind of headline you'd see coming from state media's big year-end review. The whole narrative is one of strength, of resilience. It's painting this picture of an economy that's being powered by its own consumers. That's the official story anyway.
But you have to ask, is that the full picture? The analysis we're digging into today argues that while that headline might be true for the year as a whole, it's also masking a pretty alarming trend that's hiding just beneath the surface.
Okay, so let's start by looking at that official report card. The government's year-end summary tells a very clear, very confident story. It's a story of stable growth, and it basically positions domestic consumption as the new hero of the Chinese economy.
And it's really crucial to understand why this matters so much. I mean, for decades, China's incredible growth was fueled by just massive investment in things like infrastructure, real estate, you name it. But as that engine starts to sputter, all eyes, and frankly, all hopes, have turned to the everyday consumer to pick up the slack.
So, the official summary really hammered home a few key points: that the consumer market had stable growth, and that retail sales were growing even faster than the year before. The message was unmistakable. The big economic transition is working. But what if that's not really what was happening?
And this, right here, is where the story takes a really sharp turn. Because once you peel back that shiny annual summary and start looking at the month-by-month data, a dramatically different and, honestly, a much more concerning picture starts to emerge.
The source we're looking at basically calls this a classic storytelling technique, right? You use a strong full-year number, which looks great, to kind of hide a really serious slowdown that was happening in the second half of the year.
Now this is where it gets real. Just look at this trend. You can see that growth peaked way back in May at 6.4%, and that was probably juiced by some government stimulus. But then, just watch it fall off a cliff. It drops to 3.7% in July, then 3% in September, and then it just crashes all the way down to a mere 1.3% by November. I mean, this isn't just a slowdown, it's a complete nosedive. And if you thought that was bad, this number shows just how severe it got. By November, retail sales actually shrank by almost 0.5% compared to the month before. So spending wasn't just growing slower, it was literally going backward. All that positive momentum from the start of the year had completely vanished. So the big question is why, right? Why did consumer spending just fall off a cliff like that? Well, this analysis points to 4 really deep structural headwinds that are holding Chinese consumers back. But before we jump into those headwinds, this slide gives some really important context. In most developed economies, the US, Europe, consumer spending makes up somewhere between 60 to 80% of the entire economy. In China, it's only about 50%. This shows there's this huge untapped potential, but it also points to a pretty fundamental structural weakness. Okay, here are the 4 key factors. First, you've got slower income growth and a big downturn in the real estate market. That's created what's called a negative wealth effect. Basically, people just feel poorer because their main asset, their home, is losing value. Second, there's not a great social safety net, which encourages people to save way more than they spend. Third, just extreme wealth inequality. And fourth, the boost from all those government subsidies, well, it just ran out of gas.
I mean, this chart on wealth inequality is just staggering. According to this data, about 1/3 of 1% of the population holds 2/3 of the entire country's private wealth. The problem with that is, the super rich don't really increase their spending all that much when they get more wealth. And the other 99% of people, well, they simply don't have enough extra cash to really drive mass consumption.
The analysis has a great term for this: policy overdraft. It's this idea that the government subsidies for things like cars and appliances didn't really create new demand. They just pulled future purchases into the present. It's like spending next month's salary today. So of course, when those subsidies ended, demand just collapsed.
So what does all of this mean for what's coming next? Well, the real worry here is that this whole trend could create a really dangerous negative feedback loop for the economy, a vicious cycle. And here's what that vicious cycle looks like. You have weak consumer spending, which means businesses struggle. That leads to layoffs and a ton of economic uncertainty. And that, in turn, makes people even more scared to spend their money, which, you guessed it, weakens consumption even more. It's this downward spiral that is incredibly difficult to break out of. So, the main conclusion, the real bottom line from this analysis is pretty stark.
It says that without deep, fundamental reforms to address things like income growth and social safety nets, domestic demand simply cannot fill the massive hole left by China's old growth model.
And that leaves us with this final critical question. The potential is clearly there. We saw that on the GDP chart. But given all these deep structural challenges, what's it actually going to take to unlock the true power of China's consumer and turn this really worrying trend around? That is the billion-person question for 2026.